Cool. Right. Let's get started. We're recording this so that if anybody else in the community wants to watch it later, they can do. We've got a reasonable selection of people on here. I think we've got good morning, good evening, and good night. Looking at some of the names on here from the now global Harbour Club community. So yeah, just a few things I wanted to run through on APEV. So Asia Pacific Energy Ventures is the company. They're based in Singapore, and there's kind of a few things that I wanted to cover. I guess the first one is just a more general kind of agglomeration topic, because I know lots of people are looking at agglomerations, or looking at how to put groups together and take them public and do things like this, because there is just such a large amount of value creation both for the entrepreneurs and the investors and everybody when these transactions take place, that everybody kind of wants to get involved. And I guess the common misconception, or the common question that people often have is, should I build a group and then list it, or should I list and then build a group? Because that's I think the conventional wisdom is always you get to a certain stage in your business career and then going public becomes an option. And actually, I think that's kind of rooted in the kind of the past and people's preconceptions of what an IPO is for, or what an IPO is useful for. I think people think of an IPO as being a way to raise money or a way to exit the business. And it's a terrible way to raise money. It's incredibly expensive. It's incredibly slow. It's a really brutal process. I don't think you can run a business and an IPO at the same time. I think they're two completely full-time occupations. And so for raising money, there's probably easier ways to do that in the private domain. And as an exit, really, you're only going to be a successful public company if you're not exit focused, because they're looking for a longer term story. They're looking for an equity story, and all the people that founded the business leaving is not a great equity story. That's not the kind of thing that's easy to sell to potential investors. So kind of the only way you can use it as an exit strategy is if you lie. And that's also not a great way to engender yourself to investors. So I think that traditional idea of using it to raise money or to exit is old-fashioned and not the right thing. What a public company is fantastic for is as an acquisition vehicle. Now, I'm an M&A person. My solution to everything in life is buy a company, and I will use M&A to solve any problem that I'm faced with. But public companies are great for doing M&A for a number of reasons. The first one is you have transparency. So people can very easily see what the company is doing, what its profits are, what its performance is like, what its quarter on quarter or year on year performance is like. That transparency gives them a high degree of comfort. You get liquidity, so the company's shares are tradable. I mean, if you look at MBH at the moment, it's trading over 100,000 euros a day. That means that people can, if they want to, sell shares and get out of positions and things like that. That's hugely powerful, because that just doesn't exist in the private company realm at all. And the other thing about having liquid shares is it effectively gives you a currency that you can use for acquisitions. So you've got the credibility and you've got the transparency of being this public company, but you've now also got a currency. So you can use those shares to do acquisitions. And that's really what this Asia Pacific Energy Ventures deal proves, that you can target a company that's got 90 million in revenue, 10 million plus in profits, and use the currency of your public listed shares in order to complete on an acquisition like that. And that, I think, is the real magic of using the public company environment. Now, when you're putting a group together, you don't have any of those benefits. So you can't really get a company like Asia Pacific Energy Ventures to come and join a group while it is still private, or while you're trying to put a group together. So you kind of have to have the listed company before you can start the group. It's a kind of a necessary component, and we noticed this when we did TMG as well. As soon as we started announcing some acquisitions, the floodgates open. Everybody wants to come and join. The deals get bigger and better. There are people sitting on the sidelines waiting to see if you'll kind of pull it off, and if you do pull it off, they'd love to come and join you, because I think people would love the concept of listing and love the concept of being part of a public company and having those, liquid stock instead of private company shares, which are basically, potentially worthless. We don't know if there's another, global financial crisis just around the corner. We don't know what's going to happen in the world. So, the value of the private company can evaporate, very, very quickly. So having a group is definitely more powerful. So if you're in this stage at the moment where you're thinking about rolling up a particular sector, or you're thinking about putting a number of companies together, I would probably approach it the other way around. I would probably start with the public company and then go and try put the group together. So if you already have one company, obviously you can list your one company, or you can reverse your one company into a vertical within MBH, or an agglomeration. And then use that as the vehicle to then go and attract lots of others. If you don't have a company at the moment, well, then again, we can provide you with that incubator. So you can go out and talk to potential targets, and we can provide you with the vehicle that will enable them to go public. Now, the advantage of MBH is that MBH is already listed. It's already had its prospectus approved. It's already trading, like I say, 100,000 euros a day volume. There's a massive barrier to entry to getting to that point. There are so many, the streets are littered with the dead bodies of people that thought they were going to take their company public and haven't, because it is just so expensive and difficult. And so the fact that we already have one that's sitting there, that's trading, that's fully reporting, that has really good, we're one of the best, we have one of the best trading volumes on the whole of the Xetra for small cap companies. So, to get to that stage is really a big barrier to entry for other people. And I mean, it cost us a couple of $1 million and took a couple of years to get there. Part of that was our own fault, because we've got this innovative model, the agglomeration model. So we had to get that through the regulators and get it all approved. But basically, it is still a time-consuming, expensive, and painful process to do from scratch. So either using us as an incubator, or listing a SPAC, a special purpose acquisition company, and using that as your listed entity to go on and do other deals is highly recommended. So the answer to the question is, should you build a group and then list, or should you list and then build a group? The answer is absolutely, you should list and then build a group. Most of the things that enable you to do the kind of deals that I'm talking about are only really possible when you're already listed. So that's the first kind of thing I wanted to get across. The second thing is, I wanted to just give you the standard pitch that we use when we approach a company like APEV. Now, I'm looking at the list of people on this call, and I can see quite a few of you have already been on agglomeration calls with me. So you've probably heard a pitch similar to this, but I'm literally going to almost kind of role play it to you guys as to, I mean, obviously there's the rapport building and there's the chit chat and finding out about their business. But when it comes to explaining what we do, this is pretty much what I say every time. So I start with, my background is entrepreneurial. I don't come from a corporate finance or banking background. I started in business when I was very young and grew businesses the traditional way. So, sales and marketing and trying to win customers and all that sort of stuff. In the late 90s, I started a telecoms business, and telecoms is very, very acquisitive. And so I decided that I would be the acquirer rather than the seller, and so went out and started pitching possible businesses to acquire. I did my first deal a few years later, and that was a bit of an epiphany, in that it helped the business grow by a sort of year's worth of sales in an afternoon without having any marketing expense or any kind of investment in that kind of stuff. It was a fairly small deal. I didn't have to put any cash in up front, but from a mentality perspective, it was a bit of a game changer, because I realized that you don't need to run the marathon. You could just run the last 10 yards and they still gave you a medal. So I then went on and acquired a number of other companies. I eventually sold the telecoms company in 2006, and decided to continue buying and selling businesses through my private equity firm, Unity Group. So over the next decade, I probably did around 50 transactions with my own money. And through a training program that I run, I advised on probably a couple of hundred more transactions in the kind of small to medium sized business space. And what I realized while I was doing that was that I was coming across loads of really, really great companies. And these were typically owner-managed businesses that were very profitable, often debt-free, that have been going for years and years, had a good track record of delivering profits. And we're talking about companies typically kind of over $1 million in EBIT, over $1 million in net earnings. And yet they didn't really have an awful lot of options. And you would have thought these great businesses with great profits would have a queue of people, coming out the door that they could do something with. But actually, as it transpires, they can't really get money from banks without betting a house. Everything has to come with a personal guarantee. They can't really get money from private equity, because private equity, the proper private equity, really kicks in at about 100 million plus. You might get some at a smaller level if you're willing to give up control and if you're on some crazy growth curve. And the same really goes for venture capital as well. Venture capital is really only interested in super high growth, nosebleed inducing growth, and again, ceding an awful lot of control to the VCs, and they'll want to surround you with a bunch of 20-something-year-old MBAs to support the growth of the business. And so where I live in Singapore, I live in the central business district, and we are literally surrounded with money. It's the third largest financial center in the world. There's about $150 billion worth of private equity cash sitting in bank accounts within about 100 meters of my house, all looking to get involved in deals. And globally, there's $1 trillion sitting in private equity looking to go into deals. But none of them go into the small to medium-sized business sector. And this is a really, really big problem, because the small to medium-sized business sector is 50% of GDP in just about every developed nation. So if you look at Australia, New Zealand, Singapore, continental Europe, the UK, Canada, the US, about half of the economy is driven by companies that employ less than 200 people. And yet all this money that's sitting out there just doesn't ever get involved in those businesses. And so I was looking at this and thinking, why is it that all the money in the world is so detached from all the value creation in the world? And from doing a bit of research, it basically boils down to 3 key issues that small businesses have that make them uninvestable. And the first one is they're too risky. It's just a fact of life that small businesses go bust more than big businesses do. And that risk level puts off people investing money in them. The second thing is they lack scale. So I call it the scale paradox, which is that you have to be big in order to get big. What that means is that you can really only pitch for the bigger, meatier contracts once you already have some scale. Standard procurement policy won't give a contract to a company that's more than a third of its annual revenues. And so this creates a bit of a glass ceiling for businesses that makes it very hard for them to break through. There's also simple things like access to proper credit card processing facilities and banking facilities. Taking overseas transactions can be very difficult when you're a smaller business. So this creates an unlevel playing field with the larger global companies. So risk is the first one, scale is the second one. The third one is liquidity. So liquidity is the ability for investors to get their money back out again. And if you invest in a small business, you're likely to have that capital tied up for a really, really long time. So, we've all been in business long enough to know that the 3 to 5 year plan is really a 10 to 15 year plan if you're lucky. And then you're still relying on some kind of capital event at the end of that to be able to unlock that cash. Now, smart money, big global capital, doesn't like to take 15-year bets, because you can have 3 different changes of government in that time. The whole world can be a completely different landscape when you want to get your money out as it was when you put your money in. So they much prefer to invest in sort of synthetic electronic products that they can buy in the morning and sell in the afternoon, known as derivatives. And so basically that's the reason why half the economy is ignored by global capital. So we wanted to look at how you could solve that problem. How could we unlock global capital and get it into small business? And the way private equity has traditionally tried to deal with this problem is through something called a roll-up. And a roll-up is basically where you put a number of businesses together that are all in the same sector, and you effectively use that as the as the new vehicle. Now, the problem with roll-ups and owner-managed smaller businesses is that a lot of the value in a small business is the culture that it's created with its staff and with its customers. And that culture doesn't homogenize. You can't just put a load of them together and expect to be greater than the sum of the parts. What tends to happen is that you try and rinse out all of the synergies, you upset the talented people within the organization. And when you upset the talented people, you tend to upset the customers. And so you end up with less than you kind of started with. So we took the approach that the way to solve this was to actually have an entrepreneur-driven roll-up. So instead of having a top company that buys lots of subsidiaries, why don't a group of entrepreneurial, smart, financially solvent businesses get together and buy a fully reporting public company? And the way that they do that is they effectively merge, they buy the public company using their private shares. So they swap their private shares in their small privately held company for public shares in the public company. That gives them control of the public company. That means that when we look at those three problems of risk, scale, and liquidity, we solve risk because we're now a portfolio of companies that's diversified across countries and currencies and products and markets. We solve the scale issue because you're now part of a multinational public listed company. You can pitch for those bigger contracts. You can show a big balance sheet and a big P&L when you want to win those bigger pieces of business. And you have the liquidity of being a fully reporting public company. So investors can buy your shares in the morning and sell in the afternoon. And all of that put together creates a huge arbitrage in valuation. So there's a huge uplift in the value, not only for the company joining the agglomeration, but for all of the shareholders and all of the companies that are already in there. And because this structure doesn't rely on rinsing out the synergies that exist between all of the companies, we can effectively do lots and lots of transactions. So with the company that we've just listed, we listed a company called MBH Corporation in November last year. It's done its first 6 deals now. It's a UK PLC, so the prospectus is approved by the UKLA, which is the kind of gold standard for prospectus approval globally. It's listed on the Xetra, which is the 3rd most liquid exchange in the world. And it's currently up and trading and doing around 100,000 euros a day in volumes. So yeah, we're now looking for more companies to come and join that. We're looking for profitable, debt-free, well-established businesses that want to join in the various sectors. Yeah, be really interested in talking to you about your company coming to join. So that's basically the pitch. I know it's quite long-winded, but it kind of covers all of the key components of it. And then typically people want to ask questions like, what happens if one of the companies fails? What happens if I grow? Most of the time what they're saying is, what happens if I double in size next year? And what happens if all the other companies go bust? They never say, what happens if my company goes bust and all the other companies double in size? They've always got that, you know, all entrepreneurs believe that next year is going to be their best year ever. And if they didn't, they wouldn't be entrepreneurs. It's just one of those things that's kind of, part of the makeup of being an entrepreneur, I guess. So yeah, then you just, you know, you're just diving into objection handling at that point and covering off those key points. And obviously there's you know, an answer for every different rabbit hole that they can go down. In fact, we've pitched this over 1,000 times now, and I don't think there's a sentence they can start. We don't know how it finishes. They're all pretty easy things to, you know, to kind of knock off. So yeah, that's the standard pitch that we use pretty much again and again and again to all the different targets. And that's the standard pitch that we used for Asia Pacific Energy Ventures to get them interested in joining the group. The great thing about them is they were already, you know, quite a substantial size. So their financial director is ex-Deloitte. They had really good financial reporting and financial information, so that enabled us to, you know, relatively quickly get the due diligence and everything put together on that transaction. You know, the advantages to them, very much pitching for the bigger contracts was of interest. They already deal with governments and with large corporates, but one of the things that's held them back is the fact that in kind of global engineering company circles, you know, they're up against companies like Halliburton and these absolutely, you know, Schlumberger and these absolutely enormous businesses. And so, yeah, having that extra scale and that extra credibility to be able to compete with those contracts was a really big factor for them. And the other factor was the opportunity to potentially roll up in their sector. So they knew 5 or 6 other companies that they would love to add to their group, and the way that they had kind of thought about doing that was to go and raise a load of money and then go and buy these companies. So the kind of traditional pitch venture capital, get some capital and go and buy up these companies. When they see that they can effectively keep control of the business, get the ability to pitch for bigger contracts, and the ability to then go after these acquisitions as well, it's kind of a bit of a cake and eat it strategy for them. And of course, every time they do one of these acquisitions, they're massively increasing their own share value. So so it's a very, very appealing concept. So yeah, the highlights of the business. It's actually probably one of the younger businesses in the group, only 5 years old. All the other businesses are well over 10 years old. We've got, Deboulé's 40 years old, and Parenta's 15 years old. So we've got, it's probably one of the younger companies in the group. It's got incredibly strong revenue and profitability, and a lot of that comes from contracted revenue. So they tend to act as consultants on construction projects. So building power stations is one of their core businesses, but they then have the facilities management and maintenance contract to then manage that facility going forwards. They've basically carved out a bit of a niche for themselves in getting jobs done on time and on budget, which is very, very rare when you're dealing with government or quasi-government contracts, which is what they do. So quite often with these government and quasi-government contracts, they tend to start and then overrun and run out of money, or go back for more money, or all these sort of things. They've now delivered consistently on the projects that they've been given, and that's kind of put them in the front line for every bid now that they're bidding for. So they're very, very bullish about the future, and I think there's some really fantastic kind of opportunities there. So I think that's probably a good kind of selection of highlights on the deal. If you want to ask a question, you can just ping it in the chat. So if you click on the chat box on the bottom of this screen, you can type any questions that you might want to ask there, we'll cover some of those off. And of course, if you want to get involved, I mean, if you know businesses that have in excess of $1 million in profits, are debt-free, well-run leaders in their field, it would be great to talk to them about the potential of joining MBH. Obviously, by having companies like APEV in the group, it really helps show to people the kind of size and scale of businesses that do join, and that find the benefits in joining. Look forward to having a chat with some of your clients, and you'll get to hear that pitch again and again and again when you introduce them. What I would say, by the way, is don't worry too much about getting stuck into that pitch. It's quite long-winded. It's quite specific to me, because I'm talking about some of my experiences and stuff like that. I would focus on trying to get the person onto a call with me. So instead of trying to sell agglomeration, try and sell a call with Jeremy or Callum. And then we can hop on a video call like this. We can, find out about their business, pitch them this structure, answer any questions that they might have. That's going to be a great education for you guys as well, listening to all the common questions and answers that do come up, and basically see if we can get a deal closed down. How do you value the business and divide up the shares in the PLC? So basically, we have a valuation model. So the first thing we have to do is normalize the EBIT for the company, because as you might know from the Harbour Club, profit's quite a subjective thing. You can use the same numbers to show very different outcomes. So we have to normalize that in terms of using the same sort of accounting standards and accounting principles that we would use in the public company. So quite often that's a different number to the number that they think they have as a profit figure. Actually, it wasn't that much different for APEV, because they were already reporting to a sort of standard that you would do as a public company. What you tend to find with a lot of private companies is that they're reporting to be very tax efficient. So often the profit's actually more than they think it is. So by the time you've changed the revenue recognition and cost recognition, profile. You can often end up with more profit rather than less, which is great. And then basically they get a multiple of that profit plus net assets. Now, just like we recommend on the Harbour Club, we effectively do the acquisition into an SPV. So the SPV is owned by Unity. Unity goes and buys the company. The SPV that Unity has goes and buys the company, does all of the DD and prepares everything, presents it to the board of the agglomeration, and if the agglomeration board agree that they want to buy it, then the transaction completes back to back. So effectively, with this transaction, we owned it for about a day. In fact, we owned it for a weekend because there was a Saturday and a Sunday in between. So we bought it on Friday and sold it on Monday. But normally we own it for a day. And obviously in the SPV, there is a shareholding that is us and our partners. So the next person here is, okay, I'll come on to that in a bit. Yeah, normally the next question is what's in it for you? So effectively within that SPV, we carve out a chunk of the shares for you. So effectively you own shares in the SPV. The SPV gets bought by the public company, and you then receive a capital gain effectively on those shares. Those shares cost you nothing and they're now worth something. So you would receive those shares, and typically we'll carve out 5% of the value of the company for the introducer. So on something like Asia Pacific Energy Ventures, that would have been $2.5 or $3 million if it was bought to us by a Harbour Clubber. The shares are up about 30 or 40%, 30% probably since we made the announcement as well. So that $3 million could well be $4 million by now. And I suspect it could go up a little bit more from here, because the last analyst's report that we had said that the shares should be somewhere between 160 and 220. And that was before we did Asia Pacific Energy Ventures, and they add about 70% to our earnings per share. So they increase the underlying value of the business by about 70%. It triples the profits, increases the EPS by about 70%. So if you just had a 70% increase on the last target price, then yeah, it could mean that the introducer is getting 6 or 7 million on this, which 6 or 7 million for introducing a deal to us less than 6 months ago, I think is not bad work if you can get it. So and there's plenty more of those. There's plenty more of those out there. So yeah, keep looking. So at exit point, we have 2 options: sell to someone or agglomerate. What are the benefits? So this is confusing. Sorry, this is a question somebody's asked about using so should you exit the company or should you agglomerate? They're 2 completely different solutions. When you exit your company, it's a binary solution. So it's on or off. You sell it or you don't sell it. And it's crystallized at a point in time that you decide to sell. And the event will actually happen a year or 2 years later. Because if anyone's ever sold a company, you'll know it takes 9 months to get a buyer and then another year and a bit to actually get the deal over the line and get the money into the bank and everything done. And then there might be some restrictive covenants or some earn-outs or some additional payments that are in escrow or things like that, which could be up to another 3 or 4 years after that. So selling a business isn't like somebody just gives you a check one day. There's a whole process that you have to go through. And once it's done, you're out, basically. I mean, they'll say they want you to stick around and they want you to be involved and everything else, but really they want you to get the fuck out as quickly as possible. And they'll probably engineer it in such a way that happens. So that's an exit. With an agglomeration, what you're effectively doing is you're joining a platform to enable you to grow further. So by joining an agglomeration, you still have complete control of the company, complete control of the bank accounts, the hiring and firing, all of the, everything basically the next day is the same as the day before you joined. But you have the benefits of being able to pitch for those bigger contracts. You have the benefit of being able to get access to capital through AVC, so you can get investment to go and grow the business. You get the ability to roll up your competitors, to go out and buy people and further increase your value. And you also get the ability to sell some of your company if you want to. So after your first lockup expires, you could sell a bit of the business and go buy a Porsche or a house or something like that. And that's something you just can't really do in a private company. You can't have a bit of liquidity in a private company. You have that binary choice of sell or not sell. So you really get a completely different raft of options using an agglomeration versus an exit. And this is quite a common trap that people get caught in, is that they confuse agglomeration and exit. So most of the deals that we do that don't happen because the people that are being introduced to us are looking to sell. And they're just looking for an exit. Whereas if they are looking to, if they've got a 3 to 5 year plan, or if they've got a 2 to 3 year plan, or whatever it is, I think that 3 to 5 year plan or that 2 to 3 year plan is much better served inside an agglomeration than it is as a private company, because you get loads more leverage inside an agglomeration. Plus, every year that you grow, you get additional shares. So it's not like you're picking this binary choice, this valuation today. You effectively get the benefit of your growth. So you get the upside in your growth in a number of ways. One, you get more equity. 2, you get the growth in the value of the group. And then 3, the bit that we're contributing as well is by bringing more companies in all the time. We're further increasing your value. So the companies that were already in the group, for example, since we've acquired APEV, have had a huge uplift in their own valuations. So it's quite a big difference. Next question. In the beginning, you said that going public is actually not a good strategy for owners trying to raise money or exit. But it seems to me that an agglomeration does solve this. Should we not look for companies looking to raise money to introduce you? Yeah, you could do, but the problem is most of the people looking to raise money are either desperate, they're either trying to fill the leaking bucket with more water, or they're trying to invest in some tech crazy startup type of scenario. Our ideal scenario is either somebody that wants to raise money to do M&A, or they want to raise money to give them the working capital to go and deliver big contracts that they will win once they're part of an agglomeration. So once they join our group, effectively they can go and pitch for much bigger contracts. So for example, if you've got a company that's perhaps in a government framework agreement, government framework agreements are set based on your size. So as soon as you join an agglomeration, you can now pitch for a much bigger part of the framework agreement, but you probably haven't got the cash to be able to deliver that, because you only look bigger, you're not actually bigger. So this is where the investment is ideal, because we can make sure that ABC gives you the working capital to be able to actually go and deliver like a bigger company. Yeah, that's I would say if that's what they need the cash for, fantastic. And again, APEV is a great example of that. They've got loads of opportunities all the time, and they always have to cherry pick which ones they're going to do. They can't do all of them because they're constantly reinvesting their profits in growth. And there's only so much of that to go around. So they have to select the things that they're not going to do. And this might give them the opportunity to be able to say yes to one more thing effectively. What's the typical time frame from introducing a company to closing? Really depends. So we started Asia Pacific Energy Ventures at the beginning of April. So it was very fast indeed. But that's because they're a big company and they've got a Deloitte CFO. That everything was very much up together and very easy to DD. It was blue chip and government and quasi-government contracts, so again very easy to assess and look at. But that's a pretty tight time frame. So I think if you use that, that's probably not too far off. But yeah, it depends how quickly they can get their DD information together. I mean, theoretically, there's no reason why it couldn't be done in kind of 6 weeks, but that would require everything to be bang on first time, that's rarely the case. Does it matter where the companies are based? Yeah, kind of. So we focus on Australia, New Zealand, Singapore, continental Europe, the UK, the US, and Canada. And we would look at other jurisdictions if we can demonstrate that we can own the assets. So if there's no impediment to foreign ownership, and as long as we think we can understand the legal system there enough in order to be able to execute a transaction. But those mature economies that I just mentioned, they also have that kind of perfect storm of the demographics, the number of small businesses. The fact that they've been free markets for such a long time means that there are lots of decent owner-managed businesses. They're not part of family sort of conglomerates like you find in a lot of developing nations. And that's just the way it is. How did we find APEV? It was an introduction, but introduction through my network. So not the Harbour Club network, but my kind of personal network. So funnily enough, they actually approached us with a deal probably about 2.5 years ago, something like that, in the education sector that we were kind of looking at to possibly bring into MBH in the education vertical. But we decided in the end it was a bit too small and potentially fragile. And then they came back with this. I think when we told them they had a small one, they came back and showed us a big one. It was, but yeah, just an introduction, basically. Is there a typical or rough value uplift you expect to see in a company transition from private to public? Not really, no. I mean, look, the valuation arbitrage is huge. I mean, if you look at the value of small private companies versus large public, it can be 10 times difference. So, you know, small private companies can be transacting at 3 times, while a public listed peer could be at 30 times. So there really is a massive difference between those businesses, and basically, the uplift that we get is obviously very hard to determine because it's all determined by the market and what they decide the shares are worth. So there's no kind of guarantee in the uplift, but you know, when you have 70% earnings per share growth, you would expect that over time to translate into share value. And sometimes it happens in the short term, and sometimes it takes a little bit longer. But you know, nature abhors a vacuum, so things don't remain good value for very long. They tend to normalize over time. So yeah, it should work pretty well. Somebody else asked what level of debt is acceptable. We really look for debt free. You know, we will look at companies that have a little bit of working capital finance in place, or a low level of debt, but we really try and avoid debt completely. We are exploring the idea of issuing a bond in the company, and we would use that bond to effectively execute acquisitions. So we would be issuing a listed bond instead of listing stock. So the idea that it gives us another currency effectively to trade in. If a company doesn't have more than 1 million EBIT, should we put together a number of small companies and list the parent? Possibly, yeah. I mean, it depends. If it's like really, really fragmented, it's probably not going to work. Again, if it's a company where having 500,000 of EBIT would be considered quite a big company in that sector, we might have a look at it. Or it could be, if you've got smaller companies, that they become good tactical bolt-on acquisitions for companies that we already have in the group. So the million and up EBIT basically gives them a seat at the big table and makes them part of the group. We call those our strategic acquisitions. They're the people that drive the strategy and direction of the whole group. They have the right of veto over new companies joining and all of that sort of stuff. If the companies are smaller, they can be bolted onto the existing company, so they can be like tactical acquisitions that are added to the group. So your pitch includes your background and expertise, which I believe adds a lot of value to the pitch. How do you suggest adjusting the pitch for someone without acquisition experience? If you haven't got any acquisition experience, just pitch them to get on a call with me, or pitch them to get on a call with Callum. We'll do the pitch. You'll sit in on the pitch like this. You'll follow the deal through to completion, and then once it's done, it's your deal, and that's your first bit of credibility, or your first deal under your belt, your reference point that you can then refer to when you're talking to people. So the best thing is to break that deal virginity, and we can help you break that deal virginity and get some deals done. So like I say, don't worry about agglomeration is a really cool solution, but it's quite a sophisticated solution. And so you can really get lost trying to pitch it if it's your first time. I know I did. Don't burn a whole bunch of potential deals learning how to pitch it. Come and sit in on a few and learn how to get it just right and what the typical answers are, and then you'll be doing it just as well as I do. So what happens when markets crash? Is it best to get in now or when markets are at the bottom of the curve? So look, so obviously market crashes when the global stock exchanges crash. What that tends to be is a rotation from what they call risk on to risk off. So shares are classified as risk on assets, which means they do very well in times where everything is rising. Rising tide raises all ships. But what tends to happen is that when they start to decline, when there's perhaps a risk of global recession or war or some big macroeconomic event, what people tend to do is sell the risky assets and go into less risky assets. So they buy gold, they buy things that yeah, are less considered less risky anyway. And so that rotation of asset classes is what causes market crashes. And then, of course, in the general market, it's fine to dive in at that point. And most stock market fortunes have been made by diving in crashes and just sitting there. I think Warren Buffett said the stock market is a mechanism for transferring wealth from the impatient to the patient, which I quite like as a description. But what we're building here is a small cap business, and so small cap and equity stories don't tend to follow the general market, because one of the reasons the general market becomes so volatile is because ETFs and funds and institutional investors tend to move en masse. So once there's an alarm bell ringing in the economy, everybody tends to move in one go. With small companies, we don't have that. We don't have ETFs that have to own our stock. We don't have mutual funds that have to own our stock. So we have a very different style of investor base. So we're less likely to be affected by a general market crash. But of course, we still have an awful lot of volatility, and our volatility is driven off the back of people trading our stock. So people that bought the shares a week ago for 136 can sell them today for 160. So that creates a volatility in its own right as people decide whether they're keepers or sellers, or they're selling part of it and keeping some of it. So you'll always have volatility in a small cap stock, but it tends to be less correlated to major kind of stock market moves and things like that. The advantage with agglomeration, look, we've just announced 2 deals in the last couple of weeks. We've told the market that, or MBH have told the market that they're going to do 15 before the end of the year, and they've repeated that consistently. So there's at least another 13 acquisitions to come before the end of the year. The last one grew our earnings per share by 70%, and so in terms of timing of getting in, I would probably argue that the timing is better before we've done 13 more acquisitions than after we've done 13 more acquisitions. And that even a market crash, I don't think would necessarily adjust the underlying value. Now, interestingly, if we do have a crash in our stock price, because we buy companies using our shares, what we will effectively do at that point, if there was a dip in value, is we would use bonds to buy the companies with. So we would effectively issue a bond, and so it's like a debt instrument, but it's tradable on the stock market. So people can buy and sell the bonds just like they can buy and sell the shares, and that would effectively mean that we're not diluting anybody's shareholdings, that we're keeping the business stable, but we're still able to execute on transactions, and we're still able to grow the company. And then, of course, because we're very cash generative, I mean, we've got these enormously profitable companies that are spitting off lots of cash. If the shares are undervalued, we can actually do a share buyback. So we can buy back the shares in the company. At the last AGM, MBH got the permission from shareholders to have a share buyback scheme. So they can effectively then buy back shares in the company if they happen to be undervalued at any point in the future. So yeah, that's kind of it in a nutshell. I think we've covered quite a bit there and answered the first questions that kind of came up. So yeah, if you're following the story, the ticker is M8H.GR or .DE, depending on what platform you use, but it's the Xetra listing. If you look at MBH Corporation, so it's M8H, 8M for mother, 8 number 8, H for Harry, and then after it .DE or .GR, because there are 4 listings. It shows up as Berlin, Frankfurt, Dusseldorf, and then Xetra with an X, so Xetra, like etc. almost. But yeah, look at the Xetra one. That's the main place that the stock is trading, and yeah, it's very active today actually. Yeah, keep an eye on that. Last question. Do you have any advice on lead gen for this sort of stuff? Yeah, so most of the deals that we seem to have done so far have come from networking. So most of the deals are through people that you already know. So perhaps that your next deal is in your phone would be a good bit of starting advice. So have a run through your phone, see what you can find. And then, yeah, just networking and reaching out to people and speaking to people that you already know is a really good kind of starting point. But yeah, if you find one of these deals, they're a bit of a game changer, from a personal financial perspective and everything else. Yeah, let me just put the ticker here. Somebody's just asked for it. Actually, I'll cut and paste the ticker in here for you, or the link to the Frankfurt Stock Exchange, probably the easiest. There, have a click on that link, and that should give you some ideas. Oh yeah, share price is all over the place today. 44,000 euros so far, which is quite good before the lunch break. And actually, that's just on Xetra. It's done about the same on the Frankfurt market as well. So we're well over 100,000 euros today, which is good. Right, that's about it from me. So I will leave it there. I hope that gave you some food for thought. Yeah, as soon as we do our next one, I'll post it up on the app, and I'll see you all soon. Ciao. Oh, by the way, if you haven't booked it already, first weekend of August is London, and then after that we're in Boston. 2 weeks later, we're in Boston, Massachusetts, home of Harvard Business School. So if you do fancy coming along, reach out to John or Monty and come along. We'll be doing a more in-depth case study on this as part of the course. Plus, there's a bunch of new content that's coming through. So yeah, hopefully, see you in London in August or Boston in September. So it's not a couple of weeks later, it's in September, sorry. So have fun, see you soon.